I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one, which is to say, there are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, but it's a different way of doing money.
Lynn Alden makes a compelling point. Liquidity and policy, not hype or news, are what ultimately drive markets. She demonstrates how changes in the money supply, government deficits, and central bank policies affect all asset classes, including stocks, bonds, and Bitcoin. Missing the bigger picture is the result of ignoring these forces. Her advice is straightforward. Be aware of how liquidity cycles operate, adjust your strategy accordingly, and don't undervalue the significance of rare assets like Bitcoin in times of economic development. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
They purposely take out debt they don't need just because they're basically shorting the fiat currency. Like an example I like to use is that, Coca-Cola has been profitable for like every year for like a century, and yet why do they have 40 billion or 50 billion in debt? And it's because they can. Basically that, if someone's going to offer them the ability to, issue bonds for 10 years, 20 years, 30 years at 2, 3, 4%, which, until kind of recent high rates they were able to do, it's lower than their other cost of capital. They say, well, if we're going to borrow at 2% and buy back our own shares with it, they're arbitraging the fiat currency system just like everyone else. They're just doing it in a less volatile and explosive way as doing it with Bitcoin. And so that's been kind of the go-to choice for a lot of companies, whereas Bitcoin is one, until recently, it wasn't really big and liquid enough to be on their radar. Then the accounting issues were there. And once those things were addressed, like now that it's a $2 trillion network, now that the accounting issues are addressed, we do see it popping up more. But I still think it'll take years because of the high volatility aspect of it, which means that it's more disposed that someone who owns a lot of the company. For example, Michael Saylor had dominant voting rights in the company. So if you're able to convince one person to make a really decisive move, that's where that tends to show up. It's also, I think, not an accident that Fidelity was earlier into Bitcoin than most other financial institutions, because that's a more privately held entity. So if the CEO was on board with it, it could happen. Whereas if you have a more diffused ownership where the CEO might only own 2% of the company and is basically just an employee there rather than like a true owner, you're less likely to get that kind of high conviction decision making compared to entities that have tighter ownership. That's also why you see a lot of small businesses, small private businesses will own Bitcoin. And you'll see a lot of people that are, they might be on the board of a pension, they might be on the board of a bank, and in their personal life, they might have a lot of Bitcoin because they can just make that decisive decision. But there's no one really in place at a lot of these types of entities that can just make a pretty decisive call like that if there's any degree of controversy to it, which there is because of the volatility and historically because of the accounting treatment.
Do you have like a basic way for somebody to think about this to move forward?
Sure. I would say that for any asset you own, think of the dilution. So if you're owning fiat currency and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Equities and real estate have different dilution rates. So for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one, which is to say, there are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, but it's a different way of doing money. And I do think that going forward, just zero is not the right number. It could be an amount that's not that important to you, but at least you have skin in the game now, and maybe would pay attention to it going forward.
Bitcoin may soon be replaced by a new cryptocurrency, according to many detractors. Lynn Alden, however, objects to that notion. She likens popular communication standards to Bitcoin. Instead of being abandoned and replaced, once these standards gained traction, they only developed and got better over time. According to Lynn, Bitcoin has achieved a similar level of network effect dominance in the value transfer space. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
Over the next 5-10 years, I do expect volatility will decrease, and I view it as a good thing because as it kind of gets higher toward its total addressable market, we'd expect volatility to decrease. And also, part of why people don't use it for payments at scale is that volatility. So you can't really price things in it because of that high volatility. We still live in a very fiat world. Our liabilities, either in debts or in just ongoing obligations, rent, mortgages, things like that. Our expenses are in fiat currencies around the world. So people can't really price things in Bitcoin. If Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease, and while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets to what we consider low, like gold. And so that's basically what that problem solves. But then it's up against very large network effects. So it starts in 2009. It's tiny. It's up against the $100 trillion fiat currency system, and so it's slowly growing into that. Right now, even at a $2+ trillion market cap, it seems big, but it's something like 0.2% of global assets. Gold at something like a 20 trillion network size estimated is around 2% of global assets. So I think Bitcoin is going to grow into kind of the role that gold fills to some extent, but then potentially has a avenue to grow further still because it's able to solve things that even gold itself as a money can't solve. So there's certain things obviously gold can do that Bitcoin can't do. You can use it in industry. It has all these kind of practical purposes, but as a money, Bitcoin is in many ways more powerful. It's able to beam around the world in 10 minutes, even faster by using some higher layers. And I think another way of kind of thinking about it is because, especially with your audience and in general, anyone who's technologically minded, our first thought is, well, the first technology is going to be the one that gets displaced. It's going to be some later thing that comes and displaces it. And the way that I've kind of conceptualized this is that the really big exception for that is communication protocols. Those so far tend to have a very long life cycle of lasting. So whether it's Ethernet, whether it's simple mail transfer protocol, whether it's TCP/IP, whether it's USB, once these things kind of become dominant in their fields, they tend to they update over time. So what displaces USB is the next USB rather than literally a competitor. And two, the complexity and the fast moving parts, that tends to happen at the periphery or on higher layers, whereas the core of the system itself is kind of very simple. And I think that Bitcoin is kind of following a similar approach, which is this new communication protocol that exists. And in this case, it's a communication of value. And it's achieved basically network effect dominance. So it becomes increasingly less likely that something within its own field will displace it in a similar way that Ethernet and USB and others have kind of achieved dominance. And therefore, it's going to grow into whatever total addressable market it has, which I think is north of gold's current 2% of global assets.
Bitcoin began as a small cryptocurrency in 2009, competing with a worldwide financial system valued at more than $100 trillion, according to Alden. At over $2 trillion, Bitcoin still only accounts for roughly 2% of global assets, which is around the same percentage as gold, which has an estimated $20 trillion network. Since Bitcoin addresses issues that gold cannot, she thinks it has the potential to develop into a store of value that is on par with or worse than gold. Although gold can be used in industry, its value as currency is restricted. In contrast, Bitcoin is entirely digital, can be improved through additional layers, and can travel anywhere in the world in a matter of minutes. Although it's common to believe that newer technologies eventually replace older ones, Lynn contrasts Bitcoin with communication protocols. Once established, these protocols are rarely changed. Instead, they just develop. She claims that in terms of value transfer, Bitcoin has achieved the same network effect dominance. The majority of the globe has a store of value issue rather than a payments issue. Cross-border trade is fraught with difficulties in nations with dozens of currencies and high rates of inflation. Stablecoins might be preferable for short-term payments in some areas, but Bitcoin addresses the issue of safely and anonymously transferring money across borders. Bitcoin's primary utility at the moment is as a portable, censorship-resistant store of value. However, it may eventually be used for other financial purposes as well. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.